The most common investment mistakes are easy to fix if you can identify them and use the solution that I'm going to provide you in this video today. I've helped 9-figure investors manage and allocate their portfolio. And in today's video, I'm going to give you this insight completely for free. So let's get into the 3 most common mistakes that investors make. Mistake number 1 is switching from your strategy too early. In my experience, most investors start to crack around 3 or 4 investments wrong. First investment you get wrong, you're like, okay, it happens. The second one, you're still feeling pretty confident. But after the third and fourth, the psychology of investing really starts to kick in. There's a clinical study that states that investors experience more pain from the losses than they do from the joy of gains. This was an experience that I definitely had, where when I was doing good, it was fine and I felt great, but the pain of losing and doing bad and getting multiple investments wrong in a row hurt more. You need to be able to trust your strategy and realize that even a great strategy that works amazing is going to have periods where you have consecutive investments that go wrong and that there's a random distribution of all investment results. We don't know which ones are going to work and we don't know which ones are going to go bad. Imagine if somebody like Steph Curry missed 3 or 4 shots in a row and started to change up his shot form. I see this all the time where when investments go bad, investors start to switch up their strategy and think of other ways because they feel like what they're doing is wrong, instead of accepting that this is not a sport, it's a math game, and that you are going to get investments wrong. Mistake number 2 is a lack of a clear system for position sizing and loss control. I definitely fell into this mistake when I was making a multitude of different investments, and I really didn't have a set process for deciding when to size up, when to size down, and how much I should risk on each individual investment. As a matter of fact, my worst loss was an investment in Alibaba. I started this position in 2021 when Alibaba had pulled back significantly, and as it went lower and lower, I kept adding to the position of the old adage of don't sell, buy when it's cheap. Before I looked up, the stock was down over 50%, and this investment had ballooned into the largest position in my portfolio. So imagine if the largest position in your portfolio is sitting at a 50% loss and it's your top position. When in the end, if I had a set system for managing my position size and my risk, I could have just walked away from the loss and saved a lot of time, energy, effort, and money. Mistake number 3 is a lack of true diversification in the portfolio. And I'm going to emphasize the word true. The stock market as a whole is still correlated with each other. And sometimes, whether you like it or not, whether it's a great company or a bad company, because the stock market is down, your investment is down too. So for that reason, you need to be properly diversified as an investor. Proper diversification looks like owning multiple asset classes across multiple sectors that are decorrelated from each other. Ray Dalio says that the holy grail of investing is owning 10 to 12 assets that are decorrelated from each other so that when one is up and one is down, they're not affected by each other and you can still win in your portfolio regardless of what is going on in the market. If you want the AI prompt that I use to analyze my investments in my portfolio, go ahead and check out the link in the description where you're going to be able to download this AI prompt for free. So now that we've identified the 3 most common mistakes, what is the solution? The solution boils down to one thing: risk management. That's it. And I'm going to give you the formula that's going to allow you to have a set system. Risk management can be broken up into 2 areas. We have our portfolio selection, and we also have our portfolio sizing method. The selection is going to fall into the diversification area. What assets and what specific investments are we selecting? And those selections are going to ultimately decide how successful or unsuccessful we are. I'm not going to touch too much on this area because I've covered this subject in multiple other videos that you can watch about diversifying your portfolio across the multitude of asset classes using alternative investments. The next part is your position sizing. So for this, we're going to use the expectancy formula. So what is the expectancy formula? The expectancy formula is going to be broken down into your average win multiplied by your average win percentage, subtracted from your average loss amount, multiplied by your average loss percentage. So what this is going to do is going to look at the collection of all of your investments that you've made. You're going to have some investments that work and some investments that don't work. Remember, there's a random distribution of investment results. And so when you're on a hot streak and you're doing really good and it seems like you can't miss, your average win and your win percentage is going to go up. This is going to allow you to increase the amount you invest on every single investment. And this makes sense. Sometimes we're on a hot streak and we're just doing good. Maybe we found a good edge. Maybe we found a good corner of the market that's working really well with us. And we want to milk that as much as possible until it's not working anymore and changes. But let's say the market does change and you go on a streak and you make a few investments and they go bad. Well, that means that your average loss amount and your average loss percentage is going to change. And this is going to allow you to scale back the risk in your portfolio. By doing this, you could be the worst investor ever, right? But even being the worst investor, a dead clock is right 2 times a day. You don't have to know everything and you don't have to be a market expert to win in investing. You have to have discipline and you have to have a set formula and avoid all the mistakes that we've been talking about in this video. So using this formula, when you are doing bad, you're going to peel back the amount you're investing until you're doing good again. Ultimately, if you get to a point where you have a negative expectancy, then that's your time to pause, take a break, and completely reevaluate what you're doing, because that just means that your losses are now exceeding all of your winners and something is broken in the process. Using this simple risk management formula lets you take a lot of different opportunities and a lot of different chances as well, because no matter what happens, you're never going to be out of the game. I know that during my hedge fund experiment, I would make investments and I would have no control over the sizing, and I would be worried, is it going to work? It's down a little bit. I don't know what's going to happen. But if I were to just use this formula, then no matter what happened, I would never be out of the game. I could give myself plenty of opportunities where some may work extremely well, and the ones that don't work never put me out of the game and put a lot of capital at risk. No matter what we look at for a company, no matter how we feel, there's always a random outcome. And usually the outcome that you're least expecting is what actually happens. So you always have to prepare for the unknown. And now that you know the most common mistakes that investors make, if you want to know how I learned to invest correctly, go ahead and click the video that will be linked above.